In this video, I'm going to provide an economic and real estate news brief for this past week. Alright guys, so let's start with some economic news. With supply shortages squeezing businesses and consumers even as millions of Americans remain out of work due to the pandemic, the Federal Reserve has taken center stage with a positive message. The Federal Reserve stated that today's economic imbalances are temporary and should soon fade as the health situation improves and normalcy returns. The best way to ensure that outcome in the Fed's view is to keep the foot on the gas pedal by ensuring accommodative financial conditions. Alright, so this past week the Federal Reserve stated it's starting to make plans for rate hikes and tapering due to the risk of higher inflation in their statement after its monthly meeting. It said it might hike short-term interest rates 2 times in 2023. The Fed also continued to say that recent price hikes were temporary, but Fed Chief Jerome Powell said in the news conference that inflation could rise faster and last longer than he and his colleagues have anticipated. Alright, so I just want to make sure everyone understands the concept of inflation. You may have heard the words and said to yourself, what does it mean for regular everyday people like myself? And the answer to that question is, well, it's mostly higher prices. But first, it's important to understand what inflation is and where it comes from. Essentially, inflation is the rise in prices you'll pay for goods and services. You'll have to spend more money to get the same thing. Some level of inflation, around 2%, is considered normal. Inflation eats away at the value of the dollar, your purchasing power, which is why it's so important to have investments to grow your money and earn you a greater return than the inflation rate. Alright, so in terms of inflation, prices for goods like lumber and used cars have pushed some measures of inflation to multi-year highs, with the Consumer Price Index showing a 5% annualized increase in May. That's the fastest since 2008. The Fed had forecast an annual rate of 3% this year, but it recently surged in May to a 13-year high of 5%. Powell has also said that the Fed has had its first discussion about tapering. It is currently purchasing $80 billion in treasuries and $40 billion in mortgage-backed securities to help stimulate the economy. Now here's the thing, Joe-it-alls. My biggest advice is not to worry about inflation, but instead base your investment decisions on the assumption that inflation will occur to some degree. Alright, so in terms of employment, the job market recovery had a slight setback last month. Wall Street Journal economists had predicted initial jobless claims to continue the decline, with the Labor Department reported an increase of 37,000 continuing claims. There's still 14.8 million people collecting state or federal benefits of some kind. Many people are collecting that extra $300 a week from the federal program that is set to expire in September because it's been difficult to fill all the jobs that were available. Now, 25 states say they are opting out of the program as an incentive for people to get back to work. Alright, so in terms of the real estate market, for many months now, it seemed like nothing could slow down the American housing market. But wait, it seems that the tide might be turning a little bit, just a little bit. So over the past few weeks, the rate of price growth has begun to slow and fewer buyers are seeking mortgages to purchase homes. Now, the competition for available homes, while still high, may not be quite as intense as it's been, and this could provide buyers a sorely needed opening. Housing sales were higher in May, but lumber prices and labor shortages kept those numbers lower than economists expected. The Census Bureau said they were up 3.6% to an annual rate of 1.57 million. Permits were down 3%, which is also a reflection of the trouble that builders are dealing with, but they may get a break on lumber pricing. They have dropped significantly in just the past 2 weeks. Mortgage rates shot up last week after comments from Fed Chief Powell. According to Mortgage News Daily, the 30-year fixed rate jumped to 3.25%. However, Freddie Mac had posted its weekly results for the average interest rate, and it was still below 3%. Now, some positive real estate news for investors in the single-family market is that single-family rent growth doubled during the pandemic with a one-year period. CoreLogic says rent growth rose from 2.4% in April of last year to 5.3%. That includes both townhomes and detached homes. CNBC reports that it is the fastest rate of growth in almost 15 years, mostly due to strong demand for larger homes with yards. Now, if you separate the numbers from standalone detached homes, the gains are even larger. CoreLogic says those rents are 7.9% higher, with Phoenix topping the list at 12.2%. Tucson, Las Vegas, and Atlanta were right behind Phoenix. Two big city decliners include Boston with a 5.9% drop in single-family rents and Chicago with a 2.6% decline. Also, a new report from Redfin shows that homebuyer interest in moving to a different metro that began during the pandemic continues at an elevated level. So based on Redfin.com, users are searching 31% of those people were interested in moving to a new metro in April and May. That's up from 26% in the first quarter of last year. The top 5 destination cities include Phoenix, Las Vegas, Sacramento, Austin, and Miami. And that is pushing prices higher in those destination cities. Now, in terms of real estate prices nationwide, home prices nationally aren't expected to actually go down anytime soon. Matter of fact, they're still expected to keep climbing. However, many real estate experts predict a deceleration, and that home price growth could be in the single digits by the end of the year. Home prices are unlikely to drop because of the laws of supply and demand. There are still more people who want homes than there are for them places to live. Builders have been unable to put up new residences fast enough, constrained by labor shortages, zoning laws, fast rising prices for lumber, and delays on receiving major appliances. So here are my thoughts on the overall real estate market, guys. Prices are still at record highs, and I expect them to hit another record or two this summer. I honestly don't think buyers are going to get a deal, but they may be competing with fewer offers, which is a good thing for those trying to enter the market for the first time. I don't think the sellers are expected to keep prices elevated. They've seen their neighbors' homes recently sell for top prices and are thinking to themselves they have an extra bedroom, maybe they have more acreage or a newly remodeled kitchen, so in their mind they think that their home could fetch an even more better price. Now I do think sellers may hold out for more money. If the bidding war they've envisioned don't materialize, they could remove the for sale signs from their front yards, which means fewer properties for sale, which could mean higher prices. Now real estate experts don't believe the market will really slow down until mortgage rates significantly jump up. Rates are currently hovering around 3% for 30-year fixed rates, while they fell into the mid 2% range last year. Rates are still at historic lows, making mortgage payments more affordable for buyers. If they shoot up, that equation will change. House prices have risen so much so quickly. You combine that with just a small increase in mortgage rates, and housing becomes unaffordable in many markets. So that is where we are, guys, with our economy and real estate market. I really hope you found value in this video. If you did, do me a favor and tap the like button and share it. It really helps to support and grow the channel. Don't forget to subscribe and turn on the notification bell as I'm posting valuable new content multiple times a week. Thanks again for watching, and until next time.